Hello everyone. In this video I'm going to continue my discussion for chapter 4, which is continuing the accounting cycle. And here we're going to be talking about two types of accounts, something called permanent accounts and the other is temporary accounts. So permanent accounts, these are the real accounts. These are the accounts that they're going to stay from one accounting period to another, or from one accounting cycle to another. So as it says here, accounts that are relatively permanent from year to year are called permanent accounts, and sometimes we use the term real accounts. All of these accounts are balance sheet accounts. So they are the accounts that appear on the balance sheet. So balances of these accounts are carried forward from year to year. This include accounts reported on the balance sheet. So things like assets, liabilities, and stockholders' equity are considered to be permanent accounts. On the other side, we have the temporary accounts. And as the name says, these are temporary. Once we reach the end of the accounting cycle or end of the period, we have to reset them, bring them down to zero. Another name for temporary accounts is the nominal account. So temporary accounts are not carried forward from year to year because they relate to only one period. And typically the accounts that relate to temporary accounts are the income statement accounts. So this includes all accounts reported on the income statement, as well as the dividends accounts, which is reported on the retained earnings statement. At the beginning of the next period, temporary accounts should have zero balances, and this is why we need to deal with the closing entries. So in the coming slides, I'm going to be focusing on something called closing entries. So in the closing entries, the purpose of the closing entries is to close these temporary accounts. So we know that the permanent accounts, they're staying from one cycle to another, but the temporary accounts, we need to reset them. You know the reset button? It's like we want to reset and bring them back to zero. And to do that, we have to apply something called the closing entries. So to achieve this, temporary account balances are transferred to permanent accounts at the end of the account period through journal entries. The entries that transfer these balances, we call them closing entries. The transfer process is called the closing process, and it's sometimes referred to as closing the books. And I'm sure you heard about accountants getting busy towards the end of the accounting season, and it's called because they're closing the books. So after closing entries are posted, all the temporary accounts have zero balances. And these include, again, revenues, expenses, and dividends. You know me, I'm not a very big fan of steps, but I'm going to read them anyway, and they would make more sense once we explain the journal entries or the closing entries themselves. So they involve the 4 steps. The first step is revenue account balances are transferred to an account called income summary. So we're basically in the first step, we're closing the revenue account. In the second step, expense account balances are transferred to an account called income summary. So we also in the second step, we close the expense account. And the account that we close it in is called income summary. In step number 3, the balance of the income summary that we created should equal to the net income or loss of the company is then transferred to retained earnings account, which remember, retained earnings belongs to the balance sheet. The balance of the dividends account is then transferred to retained earnings account, and that's the 4th step. So let's see a figure that explains that. So as you can see here, in step number 1, revenues are transferred in an income summary account, and that's the income summary account. It doesn't have a nature. And then expenses are transferred to the income summary. So we close it on the income summary on the other side. And then step number 3, we close the income summary into retained earnings. So in other words, we transfer the balance into retained earnings. And then the last thing in step number 4, we directly close the dividends account into retained earnings. So it's transferred into retained earnings. So income summary, what is that account? Income summary, it's a temporary account that is only used during the closing process. And typically, it's only used for one day, which is the last day in the period. At the beginning of the closing process, income summary has no balance. So during the closing process, revenues and expenses accounts are cleared by debiting or credited income summary for their amounts. Because it has the effect of clearing the revenue and expense accounts of their balances, income summary is sometimes called a clearing account. Some people, they like to call it, it's a cleaning account where we clean the revenues and expenses. The 4 closing entries required to close to the closing process are as follows. Again, let's just go over the 4 steps one more time, where we debit each revenue account for its balance and credit income summary for the total revenue. Then we credit each expense account for its balance and debit income summary for the total expense. Then we debit the income summary for its balance, which is equivalent to net income, or it could be a net loss, and credit the retained earnings account. And in the case of a net loss, the credit income summary for the amount of its balance and debit the retained earnings account for the amount of the net loss. So in step number 3, I just want you to pay attention to one thing. So if income summary is going to be debited, then we have a net income. But if it's going to be credited, then we have a net loss. And then in the last step, we debit the retained earnings account for the balance of the dividends account and credit the dividends account. So let's see how this would look like on the T accounts. So in step number 1 here, you can see that all the revenues, which is fees earned, we close it on the debit side. Normally it has a credit balance. So we put an equal balance on the debit side. And then we record an exact same value on the credit side of this new account called income summary. So let me show you here. We have fees earned, we have rent revenue. They're typically on the credit side. Now we're debiting them. We record them on the debit side. And on the credit side, we record the total for the revenues, and that would be on the credit side. So that's what happens here on this T account. We debited the 16,960, and here we have 16,840 and the 120 on the debit side. In step number 2, we do the same thing for the expenses. All expenses, they have debit balances. So we want to close them. So we credit their accounts with the exact same value for their balances. So we credit the wage expense, supplies expense, rent expense, utilities expense, all the way to miscellaneous expense. And then we add their total, and the total is 98.55. And that would be debited to income summary. Now the income summary has a credit balance of 7,105. Okay? So we want to close the income summary. So to close it, we record a balance or record a value on the debit side that would just make this income summary debit and credit matching, which would be 16,960 on each side. So to do that, we're going to debit income summary and then we credit retained earnings. Remember, retained earnings is part of the stockholders' equity. So whenever we are crediting it, that means that we are increasing it. Okay? And then the last step is to close the dividends. Dividends normally have a debit balance. We want to close it. We record the same amount on the credit side and we debit retained earnings for the 4,000. One thing I want you to remember, know by heart, is these 4 journal entries. These are the 4 closing entries. We typically do them on December 31st. We debit the revenues, credit the income summary, and then we debit the income summary and credit all the expenses. And the total for the income summary would be the total for all these expenses. And then for whatever difference between these 2 numbers, the income summary here and the income summary there, we plug it in the 3rd journal entry or 3rd closing entry, 7105, and then we record the same value on the credit side for retained earnings. So remember, the 7105 is the total of the revenues minus the expenses. If we have a case where our expenses are more than our revenues, then this income summary is going to be on the credit and the retained earnings would be debited. Again, but for the case of an income, a net income, we normally have revenues that are more than expenses. We get the difference between these 2 values, and the 7105 is calculated that way. So it's 16,960 minus 98.55. We got the 7105. And then the last closing entry where we close the dividends, we credit the dividends and we debit retained earnings. I think it's pretty easy, very systematic, it would never change. Maybe that's the 3rd journal entry is the one that might change depending whether we have a net income or a net loss situation. But other than that, it's a pretty systematic entries that we have to remember. So here we have the ledger. We update the ledger. Of course, all the permanent accounts are not affected. So you see here the cash, accounts receivable, supplies, prepaid insurance, land, office equipment, the accumulated depreciation for office equipment, accounts payable, wages payable, unearned rent, common stock. All of these are permanent real accounts. They're not affected. We don't close them. But starting from here, where we have retained earnings is going to be affected. It's not going to get closed because remember, retained earnings is one of those still permanent accounts, but it's affected by the closing of the income summary and the dividends. And then we have the dividends. This is one of those accounts that would be closed. So you see here the balance is going to be 0. We have income summary. Again, we create it and close it on the same day, December 31st, and its balance is also 0. Then we have fees earned, which is a revenue, 0. Rent revenue, also 0, it's getting closed. Wages expense, it's closed. Supplies expense, rent expense, utilities expense, insurance expense, depreciation expense, and miscellaneous expense. All of these accounts, you can see them. They've been all brought down to 0. And now we're going to start a new cycle where everything is fresh. Okay? Alright, so there is a checkup corner here. I'll leave that for you to practice doing those closing entries. Very, very similar to this example. Once we're done with that, the next step is to prepare the post-closing trial balance. And that's the last kind of trial balance that we prepare. So remember, we have the unadjusted trial balance, we have the adjusted trial balance, and then the third type of trial balance is the post-closing trial balance. And this is the shortest form of trial balances. Why? Because it doesn't have any revenues, expenses, or dividends. It only includes balance sheet accounts, which are assets, liabilities, and equity, because everything else is closed. So a post-closing trial balance is prepared after the closing entries have been posted. The purpose of the post-closing after closing trial balance is to verify that the ledger is in balance at the beginning of the next period. And then we take these balances and we start a new cycle. So this is how the post-closing trial balance would look like. You can see again, it's very similar to what we have, a list of all accounts in the business, excluding revenues, expenses, and dividends. We have our account numbers, the debit balances and credit balances, and you can see that both should match. And that's, again, we are verifying that there is some kind of mathematical accuracy in our closing entries. So again, let me stop here. In the next video, I'm going to present the accounting cycle, and we'll finalize this chapter.